Over my 35 years in finance, I have seen the financial markets rise and fall multiple times. But what's happening in index funds right now is unlike anything that I've ever seen before. So in this video, I'm going to share with you the 3 really big risks that most investors don't realize they're taking on when they invest in index funds like the S&P 500. We're going to have a look at how over-concentration has crept into the markets. We're going to have a look at how funds flow, not valuations, are determining share prices. And we're going to have a look at how if sentiment were to suddenly change, it could cause a much bigger correction than most people are expecting. And by the end of this video, you will understand how to stay diversified, how to stay calm, and more importantly, how to stay smart when everyone else is chasing the same safe strategy. Because if you don't, you can easily find yourself in a situation where you feel like you've got a diversified portfolio, only to realize that you're really just invested in 10 IT or perhaps financial stocks that are seriously overpriced and waiting for gravity to do their thing. And if after watching this video you would like to learn more about how you can take control of your financial future, how you can consistently save more money, get out of debt, get started investing, and create a life that you absolutely love for yourself and your family, can I encourage you to check out the link in the description below to my Money Boss Academy. Okay, so let's get stuck into the video. We're having a look at the hidden risks of index funds and why they're potentially not as safe as everyone is assuming. So the agenda, we're going to look firstly at the risk of over-concentration in mega caps. Now, if that sounds like gobbledygook, I am going to explain this to you. We're then going to have a look at the fact that money flow and not valuations are actually what's inflating share prices. We're then going to look at the crowded exit. So what happens when everyone wants to sell? Then we're going to look at what we should do about it. Now, I want to say up front that I am a big believer in index funds. However, these 3 risks are very real and getting bigger by the day. So a big part of this video is about helping you prepare for what's coming, to help you understand what's coming so that you can make informed decisions. And then we're going to have a look at a very quick summary. So let's have a look at the first big risk, and that is the over-concentration in mega caps. Now, if we have a look at the S&P 500, which is the measure of the value of the top 500 shares in the US. This is by far the most common, most popular index in the world. Now, what most people don't understand is that when we go and invest in an index fund, we invest because it gives us diversification. In case of the S&P 500, we invested in the top 500 shares. However, what most people don't realize is that Nvidia is 7.6% of that entire index. Its value is 7.6% of that entire index. Microsoft makes up 6.3%, Apple 6.11%, Amazon 3.9%. And if we look at the top 10 in total, they make up 40% of the value of the entire index. So just 10 stocks make up 40% of the value of the index. And what's more, if we have a look at which sectors these stocks are in, you'll notice that we've got tech, telco, tech, also in energy. You could almost say Tesla's also a bit techy. Then we've got tech, and then we've got Berkshire Hathaway, which is diversified. The thing you've got to see here is that when we invest in the S&P 500, we don't assume that we're invested in a tech sector, but you can see here almost 40%, in fact, it would be more than 40% of the entire index is actually made up of tech. And let's have a look at the Australian most common index, and that is the XJO, which is the top 200 shares in Australia. So again, you think you are diversified, but when you actually look at it, you can see here that Commonwealth Bank makes up 10% of the value of the top 200. BHP is 8%. National Australia Bank 5%, Westpac 4%, and so on. And in fact, the top 10 shares make up 40% of the total value of the XJO index. So again, you think you're diversified, but really nearly 50% of your shares are in the top 10 stocks. And what's more, if we have a look at which sectors they're in, you can see we've got financials, we've got basic materials, we've got financials, we've got consumer cyclical, we've got more financials, we've got healthcare, we've got more financials, Then we've got real estate and telco. But you can see financials again make up a huge portion of the index. So if the financial sector was to get itself into trouble for whatever reason during a big downturn, this portfolio will get hit significantly harder. In the same way, the S&P 500 will get hit very hard if we saw another tech wreck. So if we suddenly saw another tech wreck because tech stocks are seriously overvalued, then your whole index is going to be dragged significantly lower because of it. So the big lesson out of this is that even though we think we're diversified because we're investing in an index fund, often we're not, and that's particularly true at the moment. So let's have a look at the second big risk right now, and that is it's the flow of money into the index funds that is pushing share prices higher, not the valuations of those companies. So historically, if a company makes more profit, its share price goes up. If it makes less profit, its share price goes down. But that's not happening right now because more money is being pushed into index funds. Those index funds then have to go and buy shares, and those shares go up because there's more money flowing in. Now, to help you understand this, this is the definition of an index fund. An index fund is a type of investment that tries to match the performance of a specific market index, like the S&P 500, which we just had a look at, or the XJO, which we just had a look at. Basically, we're just trying to match the returns of those particular funds. And the way that we do that is instead of investing in individual stocks and trying to pick the best stocks, we just say, hey, we're going to invest in all the stocks that make up the index. So the S&P 500, we're going to invest in all 500 shares. In the XJO, we're going to invest in all 200 shares, and we're going to invest in them in the exact same proportion that they make up the index. And this means that no expensive investment analysts are required, no research teams required. We just copy what the index is doing. And that means the fees can be super low, which is not a bad thing, except for this flow of funds. So if you think about an index like a chocolate cake, so we could have a chocolate cake that's the All Ordinaries Index, which is the top 500 shares in Australia. You could have the NASDAQ top 100 tech shares, or you could have the Dow Jones cake, which is the top 30 most established companies in the US. So you've got the chocolate cake, and if you think of the index fund as a cupcake, it's got the same ingredients as the big cake. It's in the same proportions as the big cake. It's just in a scaled down version. So ultimately, it should have the same returns. The problem we've got is when we look at an index fund, let's just say I invested $100 into the XJO, so the top 200 shares in Australia. I invested in a fund, so it's going to take my $100 and it's going to spread it across all of those 200 shares. But what's going to happen is $10.41 is going to be put into Commonwealth Bank because it makes up 10.4% of the index. $8 is going to be put into BHP, $5 is going to be put into NAB, $4.97 into Westpac, $3.89 into Wesfarmers. So because I put money into the index fund needs to take that money and then buy more shares. And the more shares that are bought, the more it pushes the share price up. So what happens is it's a money flow that pushes share prices up, not the valuations, not how profitable is this company. So let's have a look at how do we calculate fair value. Now, this is a very crude measure that they use in all the financial institutions, in stockbroking firms and those sort of things to work out, is a company or is a share, for instance, is it expensive or is it cheap? And it's called the price to earnings ratio. So what we've got is the share price divided by the earnings per share. So if you think about this, this is like, well, what is the value of the share and what are the earnings of the share? And it's like saying, well, how many years worth of earnings would it take me to pay off this share or to buy this share outright? And so typically 15 times the earnings, 15 to 20 times the earnings is what's considered fair value. Now, if it's like a techie, growthy kind of company with lots of potential, then 20 times is considered fairly reasonable. If it's a more boring, staid and true company like a telco or perhaps like a consumer staple like your local supermarket, then 15 times is considered fairly normal. Now, if we have a look at this in terms of NVIDIA, we've got a P, so NVIDIA being the biggest company in the S&P 500. At the moment, its share price is $188.32. That's its share price trading today. its earnings per share is just $3.14, which means its PE ratio is 59.96. So if you remember, I said to you 20 times for a tech company is considered fair value. Right now, Nvidia is trading about 3 times above where it should be based on its earnings. Now, with tech companies, people will often just assume that, hey, it's going to make more profits in the future because it's got all this potential. So they factor some of that into the price. But to be 59.96, to be 3 times more than it's really worth, that is extreme. And you can see here that fair value for Nvidia, if it were to come back to 20 times, would be just $62.98. It would have to fall about 66% just to come back to fair value. And the reason Nvidia is way up here, one of the big reasons is because every time someone buys into an index fund, that index fund needs to go and put 7% of its money into Nvidia. More money flowing in just pushes the prices higher and higher and higher. I hope this makes sense. So let's have a look at the third really big risk, and that is what I call the crowded exit. And you probably know where I'm going with this. The problem is when we all invest the same way, we all end up owning the same assets, which works well until some investors clue on to the fact that Nvidia isn't actually worth $188 per share and its earnings aren't going to catch up with that share price anytime soon. They start selling, and then the index funds have to start selling too. Everyone starts to sell at exactly the same time. And index funds don't stop to ask, is this company actually worth it? Is this company still profitable? They're not even looking at the fundamentals. All they're trying to do is sell to meet redemptions, i.e. people selling, so they need to pay them back their money, and to meet whatever weighting the index has of Nvidia. So they're just tracking exactly what's happening in the index. And the problem with that is that a sudden reversal of flows can cause the market to fall much faster than anyone expected, and it can get very scary. And this hasn't actually been fully tested out yet. Index funds in their current form have really only been around for the last 10 to 15 years, especially the exchange traded funds. And with that sort of time frame behind them, we haven't been through a really big significant downturn because the GFC was in 2008, 2009. So it's going to be very interesting to see once we get to that point where everyone suddenly realizes that these shares aren't worth these valuations and they start to sell, what cascade effects occur as a result of the index fund selling too. So the big question, of course, is, well, what do I do about it? I'm invested in index funds. Does it mean that I should be selling? Well, no, not necessarily, because I will let you know that I am a really big fan of index funds. It is predominantly a safe way to invest in that you're not going to lose your money. Yes, it might go down significantly, and it might go down a lot more than everyone's expecting because of the risks that I've just shared with you. But I'm still a big fan of index funds, and they're a great way to dollar cost average into over time. However, it's important that you're not blind to the risk. I think a lot of people think that, this is safe. I'm investing mine in here. I'm invested across the top 200 Australian shares or the top 500 US shares, and we think it's safe. But the thing is that we could see much bigger downturns in these index funds than anyone is expecting because of the reasons that I've spelt out for you. So don't be blind to those risks. Understand that things can still go up and down, and with so much money invested in index funds, that cascade effect could be very, very real. And the third thing that we can do here is to make sure that we diversify across different indexes. I showed you just a moment ago how the S&P 500 is very much weighted to the tech sector, whereas the XJO, the top 200 shares in Australia, is weighted towards financials. You can put together a portfolio of different indexes that are going to give you different weights across different sectors. Just be very deliberate about making that happen. And then the fourth thing is to diversify across different asset classes. You don't just want to be or need to be invested in shares. You can also invest in things like gold, silver, other commodities, even crypto. So making sure that you are well diversified and not stuck in just one sector of the market. Because while some sectors are up, other sectors will be down, which means you get a much smoother ride and also a better outcome overall. Now, if this has been helpful so far, please click the like button. It literally takes 2 seconds, but makes a world of difference to helping this channel reach more people. And please don't forget to subscribe, because every week I release more videos with practical, no fluff money strategies to help you and your family thrive financially. Okay, so let's finish off now with a very quick summary. Firstly, I want you to know that I am still a very big fan of index funds, especially if you've got a long-term time frame and you can dollar cost average into those index funds. But educate yourself on how index funds really work. Understand the risks you are facing. Understand what those risks mean to you. Too many people seem to think this is simply just a safe, no-brainer option. And sure, if you've got a 10, 20, 30-year time frame, they are. But in the very short term, we could easily see significant downside, especially if we start to see that cascading of index funds selling at a rapid rate. It's a very small door and things can drop very, very fast. So we want to make sure that we understand the risks. And the way to offset a lot of these risks is to diversify. We can diversify between different index funds. We can also diversify between different asset classes. And that will not only help reduce the downside risk, but potentially it can also help your upside potential. So just make sure you're taking those factors into consideration when you're investing in index funds. Now, thank you so much for watching this video. I genuinely hope that this has been helpful, that has opened your eyes to how index funds really work and to the risks that come with investing in index funds. And if you would like to learn more about how to become the money boss of your life, if you would like to learn how you can take total control of your financial future with a simple step-by-step plan, then can I encourage you to check out the link in the description below to my Money Boss Academy. Now, please remember, it is the little habits and strategies that you put in place today that can literally make $1 million difference to your future. Take care, and I look forward to seeing you in the next video.